I'm Tracy Robertson with the Partnership Investment Program at the Ontario Trillium Foundation, and I want to extend a warm welcome to everyone on behalf of OTF, along with our partners Spring and Thrive Impact Fund. This webinar is the first of a series of in-person and virtual events that OTF, Spring and Thrive Impact Fund are organizing to advance the conversation and opportunities around blended and catalytic capital for greater community impact. We've had huge interest in this webinar. When we first put it out, 70 people signed up in a day, and we have over 150 that have signed up for this webinar. So before I introduce our guests, I want to acknowledge that I'm grateful to live and work on the traditional lands of the Anishinaabe, Haudenosaunee, and Lenape, otherwise known as London, Ontario. I endeavor to honor and respect the history, languages, and culture of the diverse Indigenous people who call this territory home. London is currently home to many First Nations, Métis, and Inuit people today, and urban Indigenous folks. As a white settler, I am acknowledging the harm and injustices that my ancestors and many others caused towards Indigenous people, and commit to leveraging my power and position towards making reparations, and to my ongoing learning journey about the history and truths as it relates to the colonization of Turtle Island. I invite you to put your name and organization and where you're from, and you can put that right in the chat at the bottom of the screen, so that our guests, Aunnie, and our moderator, Victor, can see where everyone's from. I'm thrilled to welcome Victor Beausoleil, who's the ED and steward of SETSI, an amazing, SETSI being the Social Economy Through Social Inclusion Coalition. He's an amazing leader, advisor, writer, author, and many, many things, as well as a very good friend. And he's kindly agreed to moderate the conversation today with our guest, Aunnie Patton Power. Aunnie is with the University of Oxford Said Business School. She is University of Oxford Said Business School. She's an advisor, impact investor, entrepreneur, and author of, and many things, actually, I'm not even giving it justice, of a venture finance, a book on how to create a funding journey that blends and profit and purpose. I first met Aunnie when I took her innovative finance online course that addresses the combination of impact investing, emerging technologies, and new types of deal and fund structures for social impact. I would certainly encourage you to take some of her courses, any of her workshops. And Christy, who's with Thrive Impact Fund, is in the background putting some work into putting some of those links into the chat as we speak. So please take a look at that. Before I turn it over to Victor, please note that the Q&A, we're gonna do a little bit of presentation for about 20 minutes. Aunnie will, and then there'll be lots of opportunity for questions and answers. So I encourage you to use the Q&A at the bottom of the screen. Thanks very much, and I'm turn it over to you, Victor.
Thank you so much, Tracy, for your consistent leadership, love, visionary solidarity, and as always, begin all things by just dovetailing off what you shared and acknowledging the original stewards of the various lands we're on, and acknowledging all our ancestors, all those who toiled without compassion or compensation. We acknowledge all our elders and community stalwarts whose shoulders we stand on as we build, share, and learn together for our collective liberation and sovereignty. So Aunnie, thank you so much for all that you do for so many and the remarkable work that you're doing right now. I know that I know where you're located, and I know of your phenomenal and tremendous outputs and outcomes in the ecosystem. I'm just honored to be able to not just host you and moderate the conversation, but more importantly, to go through the remarkable deck. So I don't know if I'm able to share screens, but I'm really excited to really dig in to this work and have you share with our community of practice here today. I'm going to hand it over to you.
Thank you so much, Victor. And thank you, Tracy. I apologize in advance. I have a bit of bronchitis, and so and I've been teaching last week, so my voice is a little smelly cat-esque, for those of you that remember that reference. So as Tracy and Victor said, I'm Aunnie, and what I'd love to walk you through today is a little bit, a very quick overview of where I see blended and catalytic capital playing a role in the impact investing space. So just to orient us, I like to talk a little bit about where I see us coming from. So I started in the impact investing space in 2010, right when it really was starting to get going. And the question we were asking ourselves was, can we do good and do well? Is it even possible to be able to invest in companies and that are social companies and make a financial return? And the salient question was, what is the trade-off between impact and financial return? We thought, oh, well, maybe there's a 2% trade-off, i.e. you take 2% less return and you get 2% more impact. And that was really kind of the beginning of the space. And during that time, we really co-opted traditional structures, venture capital, private equity, et cetera. I think we then moved into Impact 2.0, where we realized that we can do good and do well. A number of funds obviously started reporting their returns, the amount of capital in the space grew. We started to use other things like public equity and public debt. We started creating bespoke structures like impact bonds. We started thinking about the risk return impact efficient frontiers. And so really what we found here in this place is there's no intrinsic trade-off, i.e. if a company is more good or more social or more environmentally friendly, it does not mean that it is less financially successful. So this was very important for the space, but also meant that I would say in many ways, we started to really push this idea that you can have your cake and eat it too, i.e. impact investing does not lose money. And I think we were very, I won't say obsessed, maybe obsessed with that idea at this time, really trying to make sure that the traditional finance took this as seriously as possible and to put as much money into the capital or into the capital market, the impact capital market as possible. I think we're in Impact 3.0 now. On one hand, we have these widespread recognition of environmental and social imperatives, as well as the financial advantages of actually tackling some of these massive issues. We have mainstreamed. We have $1 trillion of impact investing by pretty much every count. And so the amount of money coming into this space is significant. Now, on the other side, I think that we are at a point where there's a small group, hopefully everyone on this call, that's really thinking about the systemic and the systematic failures that need to be addressed. Purely building financial tools that resemble the traditional financial tools and just adding impact to them will not create the types of change that we need to be able to actually work towards real racial justice, towards economic equality, towards climate. These are things that cannot be built. The financial market was not built to be able to address these. And in fact, the financial market has perpetrated the crimes against many, many people historically. And so I think that, you know, while we have this mainstreaming, this flow of capital into impact investing, in parallel, there is a group of individuals that are looking at reevaluating what traditional financial structures look like and how we think about processes, how we think about incentives. And so I'm going to talk you through how I think about that and some of the different options around blended and catalytic capital as we go. So I call the approach that I take innovative financing, which is an approach to funding enterprises and interventions that create positive and social and environmental impact. Really, the idea is that there's a significant amount of funding and a significant amount of organizations that need this funding that are creating positive impact. But really, it's this point in the middle that we're missing, this ability to actually match the correct funding to the right entrepreneurs, businesses, nonprofits, et cetera. And this is where innovative financing comes in, to be able to overcome these issues around different stages of the life cycle, the actual mismatch between the type of capital, distribution of capital to the types and the size that is needed, as well as types of standardized impact measurement. So right now, how this works is that you have a funder who has a type of financing, who finances specific interventions and looks for social outcomes. So you have an equity funder, a venture capital fund that has equity financing that finances startup businesses that then look at social and environmental outcomes. What we're talking about today is really starting with the outcomes. So what is needed and what types of outcomes are we looking for? And then what types of funders should be around the table? And what types of financing should be used to be able to empower interventions and enterprises that are on the ground and actually in these spaces that understand the needs to be able to overcome the historical hurdles that they have faced. So another way to talk about this, and that has become very in vogue recently, is systems investing or systemic investing. This is an academic space that I've been a part of for many, many years, but has only really realistically in the past couple of years really been brought to the practical level. And just as we just said, the systems investing really looks at like complexity and starting with understanding the dynamics in a context to be able to really figure out what is actually needed. And so instead of just saying one type of investment, here's how we're going to work on this, it really looks at what are the actual market dynamics, or what are the sector dynamics, what are the geographic dynamics, and how do we actually build financing that works for the outcomes that we're trying to build. So one of the things that's important about this is that innovative financing, and we'll see blended finance as well, as a subset of innovative finance, really has a broad set of actors beyond just impact investors. And this is very important because there are a broad set of resources that are needed to come to bear for the issues that we are addressing. So how I think about innovative finance and the systemic approach that I take to be able to designing the right tools is starting with the issue area and the outcomes, as I mentioned, really doing this mapping of a problem and solution landscape. What is the real issue? What has been tried before, and why is this still such a significant issue? Identifying the resources that are available or that could be available to be able to be brought to bear, and then looking at different types of business model innovation, financing tools, partnerships that can be used in the design of a financing instrument. So I'm going to show you an example of a couple of different types of financing instruments that others have actually developed. Actually, I didn't pick any of mine for today. And when I talk about innovations, I think about innovations, financial innovations around structures, processes, and incentives. So this means investment structures, capital structures, legal structures, and then under processes, the entire process around allocating capital, and incentives around compensation and contracts. So quickly switching to capital structure, which is where blended finance fits in. Blended finance is the use of grants or something like grants. That often the term concessionary is used here. It's not my favorite term because I don't think the question is always concessionary to what, but some sort of financing that is essentially what we would term below market rate, paired with market rate capital. So this has often been governments, foundations, other types of organizations that are willing to essentially put in lower cost capital to be able to source in greater amounts of capital. There's a few different ways that we do this, blended finance, and this is from Convergence, which is a great resource on blended finance. So we can put capital, essentially what we call subordinated, so below, so junior. It can be first loss, to be able to actually source in the capital, more capital in the top of the capital stack. We can put guarantees, which can be incredibly useful, alongside capital to be able to, again, mitigate risk and source more capital in. We can also use technical assistance facilities that sit alongside capital to be able to increasingly add value to underlying organizations. And then a fourth way is to actually use capital to design these types of instruments. So I'm going to show you an example of a guarantee instrument. It's relatively simple. This is the Global Health Investment Fund. It's a US fund that was developed actually quite a long time ago now, about 12 years ago now, by the Bill and Melinda Gates Foundation and SIDA of Sweden. And essentially the idea was that once drugs, particularly those drugs that are suited for emerging markets or low-income populations, once they get beyond the initial trial stage, the Bill and Melinda Gates Foundation and SIDA of Sweden felt that it didn't make sense for them to continue to be funded by grant funding. So they created this fund to be able to encourage more commercial capital to come in once they had essentially pushed these drugs through, or vaccines, etc., through the pipeline. And by being able to offer this guarantee, the SIDA and Bill and Melinda Gates Foundation were able to actually source in this, it says 55 million here, but this graphic, which is so pretty, was actually out of date. It was actually over $100 million worth of capital to be able to work on late stage development of new global health products. So what they did is they offered to have essentially a 50% guarantee on the losses of the fund to be able to encourage funders to come in to the fund. Now, another term that is often used in this space is something called catalytic capital. This is capital that sits, again, concessionary is often the term that's used, to try and move money into the impact space, really prioritizing social return over financial return. Apologies. And catalytic capital can be used a variety of ways. It doesn't just have to be grants. It can be used in all of those elements of blended finance and even more. The idea is really looking at where does there need to be capital to essentially push the market towards identifying a need and being able to create instruments that actually work for that need. So there's a few different ways we can think about catalytic capital. So it can be early stage, super high risk, essentially fueling innovation. It can be around building track record for scale. So investing in essentially new funds, pushing through ideas that are being able to actually push to that scale. There are also some arguments that there is going to be a need for some funds to be able to be essentially sustaining, i.e. continue to be in some way subsidized going forward. And this is things like impact-linked finance potentially may fall in this category as well. There's a lot of different ways to think about catalytic capital, a lot of examples. I don't have time to go into all of them today, but essentially the idea is identifying where grant or grant-like capital can really be used to be able to push instruments or markets into the direction, the deep impact direction that is desired. So one more example of both catalytic capital and blended finance that I wanted to show you is the California Freshworks Fund. Now, interestingly, also a US example. This is a bit of a success and failure. The fund was able to raise a significant amount of money, almost $300 million through a set of essentially funds that they were able to distribute from a private market, as well as something called the New Market Tax Credits, which is a government program in the United States. So the idea was really to invest in healthy food initiatives and to essentially the issue they were addressing was food deserts, which are these areas where there are very little fresh food available within a specific area. So this is how the fund was structured. So it's a blended fund with catalytic capital as well. There was $100 million in senior debt, $25 million in what we call subordinated debt, which was debt that sat below the senior debt, and then $7.5 million from a set of foundations in what's called a loan loss reserve or a first loss capital, in addition to new market tax credits, as well as some of the grants and other lending. So really a pulling together of a whole set of stakeholders that were bringing together their capital to be able to identify this issue. Now, the reason I use this example is that it is possible to structure something that looks great on paper, and this does. It is an excellent fund on paper. Interestingly, it did disperse a significant amount of loans, and there was a great amount of impact that was had. Almost 1 million people had food and increased access to food. There was a lot of innovation that came through. Jobs were created, economic impact that certainly happened through this fund. But what was interesting about this is that this was developed in the aftermath of the global financial crisis. And the actual structure itself wasn't flexible enough for the underlying borrowers and grantors and potentially investees. So it couldn't actually compete as much on the market. And they had to be able to essentially shut down a whole section of it because the actual product, even though the innovative financing, the blended capital structure, was really successful in the sense of pulling all its capital together, what they were actually using to disperse the loans was very old school, very similar. It was a term loan with a maximum of 10 years that was very rigid. And this really brings us into why, I'm just going to skip through this quickly, why we also need to think about investment structures. So traditional debt equity and grants are used for a lot of our different types of investment structures. But in actuality, there's a whole set of structures that we need to think about as to whether or not we're actually meeting the needs of individuals on the ground. Now, I'm not going to go through all of these. As Tracy mentioned, I have a book, Adventure Finance, that goes through all of these and many more. And so if you are interested, I'm happy to answer some questions about a few different ones. But the fact of the matter is that there's a lot more to say than 20 minutes. But I'm looking forward to having a great discussion. But I'd just like to wrap up by saying it's really important that we think about the entirety of the financial process. So fund structures, which include blended capital and catalytic capital, as well as investment structures that actually are responsive to individuals. And then I haven't had a chance to go into it today, but the processes by which we allocate capital and the incentives by which we incentivize individuals that are involved within the capital process are also significant to be able to overcome the historic inequities that we have perpetrated by using traditional financial tools. I think I'm going to pause it there, Victor, if that's okay. I can keep talking forever, but I think I'd rather have a conversation with you.
That's absolutely remarkable, Aunnie. Thank you so much for your remarkable leadership, all the actionable insights, and fighting through the sore throats. Or it speaks to your tenacity and your grit, and obviously your clear vocation and passion for this work. I know that folks right now, we have the ability to engage Aunnie directly through the question and answer part. So please, if you can add your questions, but while they populate, the first question that's straightforward, you spoke of a few almost horizons, but the 1.0, 2.0, and 3.0, and just a widespread environmental and social imperatives. How did you come to that realization? Was it through your lived experience as a fellow? Was it through drafting your book, your text? Was it through your social location? Like, what was it that helped you develop that framework around innovative financing?
Sure, that's such a great question, Victor. I can say that, so when I got into impact investing in 2010, I was living in Bangalore in India, working for an amazing organization called United Capital. And I can say that I pretty quickly got disillusioned with the impact investing, like not disillusioned, I guess, just I came into this impact investing space being like, we're doing everything different. This is incredible. And then I remember my first deal template that landed on my table. I was like, this looks exactly like the deal templates I was doing in New York. Like there's literally it was terrible because it was a private equity term sheet for a venture capital deal. So that was just a bad mismatch anyway. But I was looking through it and I was just like, this is like, how is this different? What does this look like that's different? And I think, that for me was just like, I knew that I wanted to be, this space seemed incredibly like dynamic and there was so much opportunity. But then I was like, but we're just doing exactly what I was just doing, except for, hopefully social organizations. And so I would say like my thinking about this like started very early and I didn't know what else to do, right? Like it wasn't like I was like, oh, we should actually be doing all of these other things. And so I think from that point, had an amazing set of people. This was, 14 years ago. And there was an amazing set of people, many of whom are like leaders in the space now that we were all having these conversations. And the fact of the matter is no one knew what else to do. And so I think that's really like guided for me the last 14 years of trying to figure out like, okay, well, we know we shouldn't just be replicating the traditional financial system, but then what should we be doing? Like, what do the structures and processes and incentives look like? And so, I've just learned from others that are like just, doing and being a little bit crazy, going against the grain. And so a lot of my work is essentially writing up their stories and, helping them, as well as identifying and building things myself. But yeah, that's really where now I can see the hindsight, the 1.0, 3.0, 2.0, 3.0. That's easy because it's like hindsight. But at the time, it really was just, we've got to do something different. Like we're not going to have the different, we're not going to make the change we want to make if we're just replicating. It's just not going to work.
I couldn't agree more. I couldn't agree more. And thank you so much for all those insights. And I think a lot of this, like your work in the UK, your work in Africa, which is incredible, your work in India or South Asia, do you feel that all that has informed the way you conceptualize how economic relationships are organized, as well in terms of catalytic capital? Like we talk about this a lot, but what are some of the ways that we can accelerate catalytic capital, or what are some of the barriers and constraints to catalyzing capital?
Yeah, absolutely. I mean, I think, I've lived in emerging markets for the past 14 years, and I think it's really important to my point of view. I like incredibly important. Just lived experience is important, right? And so I think that recognizing the realities of how capital is distributed, as opposed to just kind of sitting at the base of power, the base, I mean, I think there's a lot of things that you can gloss over when you're not seeing the like every day. And so I think that's had an absolutely a huge point. So the challenges, I mean, there are a lot. So the thing about, when we think about catalytic capital, often people immediately say, okay, well, it has to be concessionary, it has to be grant, it has to be, so like, well, how do we identify that? And so if that's the direction you're going and you're saying, all right, it has to be grant capital, there's a pool of that. And so we have to think about, all right, how do we leverage that pool as effectively as possible? And that is difficult because that pool of capital has ingrained interests. And things, ways of working, and also priorities. And so, how do you work with those to be able to encourage funders to think kind of beyond what they're used to doing, and frankly, beyond what they're comfortable doing? It is so much easier to write a grant and follow up on a grant in a grant process that's already established. Grants are incredible and we need them. But to slightly divert from that and use that grant capital to do something you've never done before, to work with partners you've never worked with before, to work with them in a way you've never worked with before, never done before, takes a lot of guts. And I think for a lot of people, it's just, it feels overwhelming. And there's this, this opportunity cost of, well, if we do this and it doesn't work, that's money we could have spent doing really good things that we know work, right? And so I think that's a totally valid piece. Now, catalytic capital doesn't have to be just grants. I think, most of my time these days is really spent with high net worth families that are really reevaluating their relationship with capital. And so they're thinking about, obviously their entire portfolio. And some of them are thinking, hey, well, I have way too much money, which many of them do. I'm fine if some of them are on the call, they know this. But why do I need to have a market maximizing return on that capital? Several of the families I've worked with have been very public about the fact that they believe they won a rigged game. So why should they continue to try and essentially exploit that? So what does a 2% return on $100 million or $150 million portfolio look like, as opposed to trying to get an 8, a 9, a 10, or 11% return? And so when you start to think about it that way, there's another pool of capital that opens up. Now, obviously with its own challenges of thinking about, how do you leverage this type of capital? How do you work with individuals? How do you actually think about that? And then finally, I think, one of the biggest challenges, but the most exciting ones, is thinking beyond that dichotomy and thinking about how do we build structures that use catalytic capital, but don't necessarily require people to take a loss or essentially to get, but we actually use ways to mitigate risk, like guarantees, like listing on the public markets, like how do we actually design, and this is what gets me excited, and this is what I love to do, is how do we build products that potentially use some of that catalytic capital at the front end to actually build them, to put all the pieces together, but where we actually can use, retail capital. We can pull it together with long-term pension fund money. We can find ways of creating these pools that are able to then be responsive still to like on the ground needs, but have in some cases wrapped them up, and from a risk mitigation perspective that they actually look very vanilla. But we've pulled together a set of funders, and it's and that's more complex. But I think that we're in the stage now where there's the ability to do that, because there's so much, essentially so many things on the ground we can pull together. And so the challenge there is complexity and working with a set of stakeholders that you just create this complexity. And I think that's for me, I get excited by that, but it does add like human complexity, financial complexity, market complexity. And so, we need to get that right. But being able to get that right over and over and over again, and ways to replicate some of those structures is definitely hard.
That's incredible. Thank you so much for your leadership, transparency, and your candor. So the next question is from the chat. What is the most innovative structure you've seen to date that has also been successful at attracting a broad spectrum of capital types, and what allowed it to succeed?
Ooh, that's a great question, Aaron. Oh, I had to think about that. The most innovative and the most money. That is a nice Venn diagram there. I'm working on a very cool one that I think is going to fit into that, but it's not live yet. It's around employee ownership in the States. But it's not live yet, so I can't say it's definitely successful. But we're doing some very cool pieces there. So I think actually I'm going to, one of the ones that I was the closest to that I will reference is actually one that I developed, or I did the concept for, and then the team actually developed here in South Africa. And it's called the Green Outcomes Fund, or the GOF for short. And the idea actually was, so we got money from a foundation and from the South African government to create this outcomes pool that then had essentially a tariff card of green outcomes that funds could bid for, with the idea being that we wanted to incentivize these venture capital and SME financing funds to go out and actually invest in green. Oh, thank you, Christy. That is the Green Outcomes Fund. Well done. You can read more about it in the chats right there. To go out and invest in essentially more green technology and green companies. And what happened, which is very cool, and you can see the results there. So essentially there was foundation money, government money, and then the funds used their own LP money to be able to make the investments. And then once the investment started to create these outcomes, they were able to then essentially take them. So green jobs created, megawatts of renewable energy, tons diverted from the landfill. They were able to take these and essentially submit them to the fund and get paid for them. And so what was quite cool is that these funds started to develop these new financial models. So whereas they would go, say they were going into a recycling investment, they might have run their traditional financial model and looked at the business model and said, okay, this is going to make us a 12% per annum return, but we actually have a 14% minimum kind of like hurdle to take this to our investment committee. And so then it wouldn't have passed otherwise. But then what they would do is they would say, okay, well, if we model out the tons diverted from the landfill that we think this is going to actually achieve and how much we're going to get paid from this outcomes fund, actually that adds on an extra 3 or 4%, say, per annum. So the actual return from our perspective is going to be 15 or 16%. So we can take this to our investment committee and say, the company is going to produce this amount of revenue, and we're going to claim this number of outcomes. And then so we can actually do investments that otherwise we wouldn't have been able to do investments for. And so that, I think, I'm really proud of that one. The team did an incredible job of putting it together. You can see in the chat, some of the results are up there. It's been live for a number of years now.
That's incredible. I only think of my brother Jeff Sear from Raven Capital and the work they're doing around outcomes financing in Canada. With a finance fund. So remarkable. Thank you so much for your leadership and sharing that. So next question, you mentioned that you need different financing models. To your example, with looking at same deal templates, but new financing models can be confusing because of potential LP investors. How do you persuade these investors that we need different structures than the types that we currently have today? And are they likely to invest in these structures the way they used to invest in more traditional structures?
Oh, such a good question. We've got a great audience here, hey? So yeah, how do you convince people? You never convince people to do anything, right? You just give them suggestions and then you hope that they take them on as their own. So, I think when talking to investors, it's, for me, the thing to highlight really in general for these investment structures is really that what they already know, which is most of the companies coming to them are not the traditional venture capital type of company. So, they know that, they see that all the time. They're getting, pitched these companies, they're working with these companies. They see that it doesn't make sense for these companies necessarily to come in and then look for an exponential growth and then try and exit in 5 years. And so I don't need to convince them of that. And I'm not going to convince them of that. If they're not seeing that, then that's fine. You keep doing what you're doing. But most funders see that, and they see that there's a whole set of entrepreneurs, especially if they're looking at from a racial equity or an economic inequity perspective or geographic, historic biases. They see these entrepreneurs that are not standing up in front of them with perfect pitch decks with these hockey stick charts that are going to go off, and build the next Airbnb. And so if they are asking themselves, but then how do we as funders actually engage with these? What I try and do is present them with a set of options that others have used. So, I didn't go through these, but things like revenue-based financing, which is actually really simple. It's a type of loan that's based off historic revenues that's repaid by future revenues. It's growing very quickly globally. Or things like redeemable equity that allows a founder to repurchase their equity from you so that they don't have to continue going to raise and raise and raise and raise in the future. They can actually build a sustainable organization. Or something like supply chain financing. So actually using customer orders to be able to finance themselves. And I think these are all really important. And the things that I try and do is to build useful tools. So Christy, I'm also going to play at your chat game and put 2 of the tools that I have developed in here. So with Village Capital, I worked on developing a capital explorer model, which essentially here, I put it in the chat there, which essentially allows you to, as either an investor or an entrepreneur, essentially answer a series of 15 questions about the organization or about the organizations you fund. And then it shows you the types of funding that make the most sense for those types of organizations. And then also for those of you that are I know most of you are Canadian, and then there are some overlaps with US policy, but a little bit more. Oh, shoot. Sorry, I put that host in. Sorry, let me try that again. Didn't do it to everyone. Did it to hosts and panelists. Let me do that again. There you go. So there's the Capital Explorer. And then also innovative.finance, which I worked on, which was partially funded by a grant from the US government. Also has a series of tools, including models, for people to be able to model out what the difference is between some of these types of structures. So I think really, and there's also example term sheets in the innovative finance as well. And the Capital Explorer is linked up to that innovative finance too. So I think, trying to be useful, i.e. go to funders that are saying, here's a problem we have, and be like, here are examples of what others have done. Here's what term sheets look like. Here's what legal language looks like. Here's what models look like. Here's what, so really having all of those tools available so that it's a bit easier and not as complex. And the reason I wrote Adventure Finance the way I did, which is very accessible, is for funders that are doing these types of models that want to use it as a resource also for the entrepreneurs they're engaging with, to help them. And I think Christy put up, there's an online companion to the book, and I have, for instance, a term sheet section that like goes over in plain language all the different elements of the term sheet. So I think it's really like creating these resources and tools to try and make it less complex, is really part of how, you get this going.
That's incredible. Thank you so much for all those actionable insights and the resources you shared in the chats. I always love when I connect with thought leaders and practitioners, especially when they're in one. So the next question is, can you share more about the sustaining elements of blended capital structures? How do you think about it? When is it appropriate or not? And what do you say to folks that think it's lesser than, that folks that think it's charity or unsustainable, or perhaps even floating bad enterprises?
Oh, it's such a good question. I am loving these questions. This is such an excellent discussion. So it's the most controversial one. So when you think about kind of the seeding, scaling, sustaining. So everyone agrees on seeding, everyone agrees on scaling. There is a definite like deep conversation around sustaining. So, are we just propping up? Are you using funding to prop up? So I think there's two times in which it makes a lot of sense. So one is when we want to use catalytic capital, or blended finance, or impact-linked finance, another term that is used within kind of this field where we are actually paying for outcomes, to really incentivize organizations to go to deep impact. Now, I mentioned at the very beginning that, we kind of realized in impact investing that there's no intrinsic trade-off, i.e. just because a company's social doesn't make it financially poor. That being said, what we do know is it's more expensive to go deeper impact, i.e. poorer, rural places or types of populations that have had historic discrimination, historic injustice. And so it's by just saying, oh, well, those people should just like deal with it, we should just get up to that just doesn't make any sense. So there is a real argument to be saying that the market often misprices risks, misprices opportunities as well. And so finding ways to potentially use catalytic capital, for instance, for lower cost loans to Indigenous entrepreneurs. Like the market misprices that risk in some ways, but in other ways, there's been such a history of financial inequity for those individuals that expecting them to pay market rates or to qualify for market rate loans glosses over that. And so thinking about long term, and who knows, it could be medium term, but really providing the type of capital that makes sense for entrepreneurs, for individuals, micro SMEs. Like there are individuals that for which market rate and projects, for which market rate financing just is not the way to actually create impactful organizations. And so, I think there is that argument is like, well, maybe there's going to need to be capital that is below market rate. And again, I mean, market rate can be such BS, but for long periods of time. And that it might not be where you just get the project going and then 2 years down the line, all of these Indigenous entrepreneurs who have faced hundreds of years of persecution and unequal access to finance aren't going to just magically make themselves able to address these loans. So I do think there's a piece there. And then the other way is around thinking about, for me, some of these outcome-based funding. So really thinking about paying for some of these outcomes that there isn't necessarily the direct end user is not able to pay for all of them. Things like some of the free rider problems that we struggle with around environment, around social impact. So finding ways, I think, to potentially quantify some of these outcomes that we do want organizations to go after, similar to my example with the golf. And that might be long-term that we pay outcomes bounties, prizes, whatever you want to call it, that does end up subsidizing, this work. And that might be something that eventually goes away. But, I think if used effectively, these types of small pieces, the impact linked or pieces of catalytic capital on top of more traditional finance actually offers a huge opportunity for leverage as opposed to traditional grant financing that pays for the whole project. So finding like what is sustainable and then what is needed to essentially get to that level of sustainability. So if you have market rate capital willing to do a certain amount, and then like what type of catalytic capital is needed, even into the long term, to be able to make this type of project sustainable. So it might be that on a $100 million project, there's $5 million of ongoing catalytic capital that's needed. That still means that you're sourcing in 95 million of other types of capital. So I think it is just like thinking about like, how do we do this effectively, and making sure that, in the end, it is sustainable organizations, and that's easier said than done. And sustainable, not just from a financial perspective, but from a social perspective.
No, that makes perfect sense. Thank you. I appreciate all those insights. So I'd love to hear more about the incentivization approach you mentioned. It seems to me that it might be essential to getting people to think a bit more outside the box.
So incentives are huge. I think there's a ton of ways to do it. Actually, do you mind if I share my screen again? I've got a slide on this that I didn't share. Okay, great. Here we go. Let me just get to that. So, I think of this in a few different ways in the actual deal structuring. So you can incentivize companies and link impact in around the cost of capital, which we see quite a bit, around how you actually distribute funding. And this is historically, grant funding does this a lot around disbursements and, tranches. You can actually do it around ownership. So there are ways to link ownership to impact to incentivize additional impact. And then thinking about convertibility. And this is particularly around things like what are called recoverable grants, that are grants that convert into loans, or forgivable loans that are loans that convert into grants. So thinking about how impact can affect that. And then also a piece of work that I did last year with an amazing team was around impact-linked compensation. And this is specifically for fund managers. And so essentially in 2022, I kind of been very public about my, I will say, disgust with the fact that most impact investing funds do not have any sort of impact-linked compensation, i.e. the people within the funds themselves are only being incentivized by financial incentives. And I don't think that makes sense anymore. I don't think it's made sense for a long time. And so what we did is we spent about 9 months talking to as many people as we could. We ended up engaging with about 200 organizations, about 80 of which had impact-linked compensation, meaning that the return, the actual financial return to the individuals at the funds was based off of both the financial return of the funds as well as the achievement of impact objectives. And there's a variety of these. So carry, which is used by impact investing firms, can be impact-linked carry. You can have bonuses based off of portfolio performance or individual. You can also integrate it into performance evaluation. I'll put the link in the chat to this piece of work, but it's a very kind of deep, in-depth piece of work on what you need to think about if you are integrating impact-linked incentives into your fund. And I think that's incredibly important because otherwise, I think we can really lose sight of the fact that we are building these funds to optimize impact as opposed to just optimize financial return.
I couldn't agree more. Thank you so much for sharing the screen again. And once again, like showing that difference between mere thought leadership and practitionership. Next question I have is around harmonizing the supply and the demand side of capital. Obviously, it's a challenge in every jurisdiction across the planet. How have you found ways and means to, one, create empathy on the demand side of capital for the constraints and the challenges of high net worth individuals, philanthropic foundations providing catalytic capital, or large institutions like pension funds, and vice versa, translating the needs on the ground for capital to these large institutional investors? And like how have you been able to hold those two spaces and those two very distinct groups, the supply and demand side of capital, and harmonizing them?
Oh, I would definitely not say, Victor, I am harmonizing them. I think I would love to be able to say that I do. I think it's a beautiful question, and I think one that like really shows a deep understanding of this space, because I think there's, the entrepreneurs, if put together in a room, and nonprofits and all of the different types of founders that make up this space, and are asked about their single biggest issue, they'll always say finding capital, even though it's not as simple as that. They'll say that it's finding capital. And then you put a bunch of funders in a room and you ask them like, what's the hardest thing, and they say, oh, finding deals. And you're like, but wait, what, how are both of these things true? And so I think there's a profound sense of frustration, particularly on the founder side, with the lack of availability of the right type of capital. And so I think that for me, the way that I've tried to do that is by doing education on both sides, obviously on founders and funders, often bringing them together in the same room to have them be able to share. And I think just teaching founders, as you said, about the constraints, and teaching them that funders have their own gatekeepers. So a lot of people think you just pitch a foundation, you pitch a pension, whatever. It's like, no, actually, like you're having a conversation with them. They will then create something that has to be then pitched internally. And so there's a whole section in venture finance about this, about like understanding who the gatekeepers are, because otherwise, you just can think that there's this, this person that's making this decision, when actuality it's a series of those. And so I think it's the only way I can say to trying to do it is just trying to make things more transparent and trying to do that translation. So just trying to get things more in plain language, so that when we're talking, we're not talking past each other. And I encourage funders to do this, to really kind of speak in plain language, as opposed to acronyms and the types of convoluted ways in which we talk about finance. And so trying to bring them together. And then I also think, getting funders to really listen to what founders need, as opposed to just being on the hunt for the type of founder that fits their preconceived notion, and essentially the type of financing that they have. So like really thinking about, okay, wow, like, I'm supposed to be working with African female entrepreneurs, and I have this, like, I'm going to write this $5 million equity check, and actually going out and like speaking to a lot of, African female founders, saying like, I don't want a $5 million equity check. Actually, like I really need, $200,000, $400,000, $500,000 of like really patient risk capital. Or, I could just use, a super risky loan. Like I actually would love, so just, I think for funders that have the ability to be flexible, recognizing that, because there are a lot of funders that don't, and I don't go around telling VC funds to like go do crazy things, but there are a lot of funders that do. And I think recognizing that and saying, oh, we could do things differently, is important. And then having that conversation with entrepreneurs to say, okay, what do you need? Like what would us really supporting you look like? I still can tell you though, there's still lots of frustration on the entrepreneur side. There's just still this like, there's some of it merited, some of it not. And I don't know that. I think there's an impatience with some of these constraints, which I think some of which is healthy. Like, you have all this money, like you should be doing something effective with it, is actually like a very good thing to be pushing some of these funders on. Like, this is like, the time is now, like the place is here. Like, let's actually do something. And I think that's a good impatience to continue to push funders on.
Absolutely. And there's so many funders doing incredible things. OTF, my colleague Smith Adas and Matthias at World Education Services. I can name so many that is doing really dope work in the space. That's absolutely remarkable. So I feel like a lot of these questions have been so technical. It's like a deposition. So I want to kind of shift gears a bit and go to, you're great on your feet, which I love. But what's inspiring you right now in your work? What has you curious, or what's keeping you up at nights around this work?
I think let's go for the positive one. What has inspired me? I think there's so much we can get negative about, but so what's inspiring me? I right now am doing some pretty large scale work with a group of funders and organizations around employee ownership in the United States. That's one of the projects I'm working on. And it just, I have to say, I mean, if we can get this right, it's going to be multiple hundreds of millions of dollars pushed into the ecosystem. And the more I engage with these fund managers and nonprofits and others that are doing this work around these employee ownership transitions, and like seeing the way that this tackles racial inequality and wealth inequity, and like just the tangible impact this can have on millions of people, regardless. And this is like, I mean, it's government enabled, and I know Canada has some legislation that's coming through around employee ownership that's going to be really important. And I think, and it's obviously not the panacea, it's not the answer to everything, but I think for me, it's really exciting to see something that I think can be replicated in many, many other markets, and has been done historically really badly in some markets, including South Africa. There's been, just very much, share transfer without real like agency that have been given to individuals as part of kind of some of the apartheid legacy. But I really get excited about what it would mean for more people to own businesses, to profit from them, to be able to access the wealth creation that is created for them, and that sense of agency of not just being a wage worker, but being an owner of a business. And using innovative finance to be able to create the type of capital that's needed to make this affordable and inclusive and a really kind of community-led movement is really exciting. And then the other thing I'll just throw in there, the other piece of work that I'm quite excited about right now, which is totally different, is something called strategic litigation, which is essentially suing the hell out of big companies that are not going to change any other way, and governments, et cetera. And so thinking about how do we really fund some of these large scale human rights abuses, climate cases, and just like really, I would say, make some changes at some of these really big companies that I just don't think are going to do it otherwise. Like that gets me excited too. Like it's time for us to like bring out the, I'm not a fan of guns, but bring out the big guns. And really kind of, those two kind of things right now are what's getting me excited. And I'm hoping that there's always going to be more. There's always more.
That's incredible. Actually, yeah, there's a lot happening in Canada. I sit on the Canadian Employee Ownership Coalition
Oh, do you? Oh,
task force.
cool.
And my beloved colleague Bill Young and John Schnell and Matthew Mendelson,
Mm.
social capital
Yeah.
has been doing some great. And Rachel and Arnie at Employee Ownership Canada are doing some great work.
Yeah.
So yes, there's a big movement happening around that. So thank you for sharing that. So there's another question in the chat. How critical is it to deliberately invest in building the ecosystem? So not just building the new funds and products and pools, but the network, collaboration, partnerships amongst the players in the impact space. So market making, essentially.
I don't know who wrote that, but it's a really good question, and actually something I am actively working on, kind of in stealth mode right now. So if anyone is interested in potentially supporting something around that, give me a shout. I think it's critical. So I don't think this happens without people speaking to each other, speaking the same language, being connected to each other, being connected to resources, taking time to ideate, brainstorm, engage around what needs to be created. I don't know how we do this otherwise. Otherwise, we're all just going to be doing our own things kind of talking every once in a while. But I think this community and the community of funders that are like dedicated to building what is needed need to be very, very well connected.
Absolutely, I couldn't agree more. Ubuntu, Uhuru, like unity of strength. I am because we are. These are principles
Yeah.
that are global. So I couldn't agree more. So Michael Trent has a question in the chat. You've spoken a lot about social and environmental impact. What about cultural? Do you have any observations about the specific challenges or opportunities in this space? So I'm assuming Michael's talking about cultural imperatives or yeah.
Yeah. So the best, so I think there's some great work around, I mean, there's lots of amazing Canadian funders that I've worked with as well that do incredible work around culture. But also in New York, there's an organization called the Upstart Collab that has done the best, I think, work on kind of innovative ways to fund arts and culture. I can put a link in the chat. So the founder is just is incredibly thoughtful around that. So because I think it's incredibly important. I obviously have done a bit of work, but I think that she's done the most work of anyone I've seen in the space. There we go.
Incredible. And that question came from our brilliant colleague, Brian from Bowen Capital. Him and Wayne Miranda are doing some incredible work as one of the wholesalers for the Social Finance Fund.
Oh, lovely.
Yes. So the next question is, in terms of this work, I know you spoke about what's inspiring you, what has you curious, but I'd love to find out what's giving you any anxiety or trepidation, like in terms of challenges and barriers.
Lots of things. I would say I'm afraid we can't do enough fast enough. I'm afraid that we are going to just get caught up and in our own navel gazing and not actually get money to people that can do what they need to do with it. And so for me, my concern is not that we'll get there, that we won't get there fast enough. That's my biggest thing.
That's incredible. So Aunnie, thank you so much for your leadership, your candor, your brilliance, authenticity, and all the innovation you bring to the sector. All the way from Cape Town, South Africa. We appreciate your time and all that you do for so many. So do you have any closing thoughts or calls to action for all those in attendance today?
Absolutely. So I would say, just learn as much as you can, and teach as much as you can, but just, continue to learn, engage, figure out what it is that, you can do with the resources that you have, how you can work with partners, how you can get, more innovative around being able to leverage your own capital, others' capital. This is a space that we're all building. And I think the only wrong thing to do is nothing. And so just being able to continue to push into the unknown, and really just being willing to be courageous. And that's what I tell people most of the time. It's like, this is going to require courage. And so, as a funder, being courageous is really important, because there are founders out there that are every day taking huge courageous leaps to be able to create the types of organizations and initiatives that are just incredibly important. So thank you so much, Victor. This has been an expertly facilitated discussion that I have enjoyed very, very much.
Well, listen, this was a masterclass in innovative finance and so much more. And as always, we close the way we began, by giving thanks to our creator, by giving thanks and acknowledging the original stewards of the various lands we're on. We acknowledge all our ancestors, all those who toiled without compassion or compensation. We acknowledge all our elders and community stalwarts whose shoulders we stand on as we build, share, and learn together for our collective liberation and sovereignty. Thank you so much, Aunnie. We so appreciate you.
Have a great rest of the day. Thank you so much, Victor, and the team.